Welcome to the Lend Academy podcast, episode number 59. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I am delighted to welcome Rohit Arora, who is the CEO and co-founder of Biz2Credit. Now, it's the second time I've had Rohit on the show. We wanted to get him back on again because they're always doing such interesting work, it feels like. I've seen some of their surveys and some of the studies they're doing, the partnerships they're doing. A lot has changed since we last had Rohit on over a year ago. And also not just inside his business, but I think inside small business lending in general. So we'll get an update on Biz2Credit. We'll get an update on Rohit's view of the economy today and where he sees small business credit going and the trends he's seeing there. And we also talk a little bit about the industry and where he sees his company going. Hope you enjoy the show. Welcome back to the podcast, Rohit.
Yeah, Peter, thanks for the opportunity.
Okay, so for those people who are listening who aren't really clear about Biz2Credit, can you explain exactly what you do?
Yeah, so Biz2Credit is an online small business credit marketplace which me and my brother co-founded 7 years back, with a mission to help small and mid-sized businesses get access to credit in a seamless and intelligent manner. And we have done over now 1.4 billion in lending. We have over 250,000 small business clients on our platform who use it for access to credit as well as to get business intelligence for their businesses.
Mm-hmm. Okay. So then what kind of loans are you offering today for these small businesses?
Yeah, so that's a good question. So we offer the four kind of loans. So we offer them short to medium term working capital, ranging anywhere from 6 months. Now we go up to 5 years. We offer them loans against commercial real estate. We also are launching products to offer them for their equipment financing also.
Okay.
Besides these three product categories, we also do bridge financing.
Right. Okay. And then, who is a typical small business? Are these like really micro businesses, or are they, they're small businesses with profits and revenue? Can you give me some examples of the kinds of businesses that are coming to you for loans today?
Yeah. So I think that's a very good question because we have seen a big sea change in the demographics of the businesses which are coming to us for loans now, So just to give an example, just 15 months back, we only had 3% of our customers were more than $10 million in revenue and more than 5 years in business. Now that percentage has gone up to almost 1/3 of our businesses, which are borrowing are more than 10 million in revenue and more than 5 to 7 years in business. We have seen average credit scores on our platform jumping up from 660, 670, right now it's 696, actually. So we are seeing a lot of disruption moving upstream. We are seeing actually, in last 1 year at least, is that, more and more people actually are looking for access to credit who are actually more well established. And that's a function of the economy also, because as the oil prices have significantly dropped over last 1 to 1.5 years, a lot more well established businesses are looking for longer term, cheaper money. And also they're looking to, refurbish their equipment or do more, expense towards their capital improvements and all that in their businesses. And that's where we are seeing more money now going towards than just working capital.
Right. Okay. So that's interesting that you're getting businesses that are obviously a lot more established. So I imagine at the same time the average loan size is going up. Would that be fair to say?
Absolutely. So three things have happened. If we look at our 2014 cohort data, our average loan size on the working capital side was around 80,000. We have seen a lot more renewals, new loans, so that has gone up to $110,000.
Mm-hmm.
We launched CRE products where the average loan size is around $750,000. On the equipment financing side, we are seeing the loan sizes of around $250,000 to $300,000. And the other thing that we have also seen is that, our 2014 cohort data shows that our default rates were around 1.6%. And actually that has also gone down right now to 0.56%.
Wow.
Actually.
That's
and that's
fantastic.
a combination of both better quality business and better data analytics and more mature scorecards also.
Right. Because that's right. Because I just want to spend a little bit of time talking about that the virtual CFO product. I believe, is that what it's called? This is where you get all this incredible intelligence about your these small businesses that allows you to make better underwriting decisions. And this can you explain a little bit about that, what that virtual CFO product does?
Yeah, so one of our visions always was when we set up the company, and as we keep growing the company, has been that that most of the small business owners don't have any CFO or in-house CFO in their company. So we said that if we can provide them with an intelligent platform where they can sync up their accounting, their payroll, their payments, their marketing, and their tax data directly into our platform, then we will be able to provide them with an ability to benchmark their business. We will provide them with an ability to do a lot of business intelligence on their business in terms of their personal credit scores, their cash flow analysis, their revenue projections. And that we have found to be a very successful strategy. Now we have over 250,000 small and mid-sized businesses which are using that tool of ours. On an average, they will log back at least once a quarter. They get alerts directly if their credit score has dropped or if their cash flow of their business has gone down. And sometime in December of 2015, we also launched a simulator tool because we were finding that a lot of these businesses were coming and they were actually looking at different scenarios. So one example was that in certain months they had more bounce checks, in certain months they had more deposits. Right now it's time to file their taxes, so they are looking that if they file their taxes late, what happens to their business and all that kind of stuff. So we actually came out with new version of that tool where now the businesses can simulate all their situations and then they can see what impact that will create on the cost of credit and the overall credit worthiness of the business. And we have found that to be a very good tool because not only are we getting data now, we are also getting behavioral analytics on top of it. Now we can see what is worrying a business owner. And since this is free for every small business owner on our platform, irrespective of the fact whether they get money or not, we are seeing some very high re-engagement rates. When we launched our commercial real estate product, we found that within first 6 months of launching it, we had a 26% plus cross-sell rate to our existing customer base. So that clearly shows that if you engage the customers well, if you give them tools beyond credit, they will become better creditworthy customers, and they will also give you more intelligence that can be incorporated into the scorecards and other behavioral analytics that you can do on top of it.
Right. Yeah, it's a real win-win, win for you and a win for the company because they get a useful tool. So that's great. Okay. So I want to talk about the other side of your marketplace and who is funding these loans. I know you have a variety of different kinds of investors. Can you just take us through those different types of investors?
Yeah, so we have family offices, we have credit funds like direct lending, Ranger Capital kind of guys. Mm-hmm. We also have now, some international pension funds which have come to us and they have started buying loans. So that's the other thing. And I recently wrote an article in Forbes also around it that we are seeing more international investors, institutional investors who are coming in. Yep. And one big reason for them to come in is that, they're looking to book more assets in dollars. With China's slowdown happening, more Asian investors are looking to have more assets in US dollars based out of US itself directly. And what they're also foreseeing is that, since the US economy is going to get better, or at least it's the most stable economy in the world, so this is a good time for them to book these assets into the fixed income groups. We have also seen banks starting to come back and starting to buying seasoned assets. They are still not there to buy loans upfront. They are trying other things to do that, which I will come to later. But at least we have seen the movement where these banks are now coming in. And let's say once these loans have been paid down for 6 months or a year, if it is a 5-year loan, they are willing to buy these loans from institutional investors and also give a better pricing and a longer term to the borrower, while Biz2Credit is still doing the servicing of those loans and still gets all the data to be inputted back into our credit models, and also the customer experience doesn't change at all. So there's no disruption in that, while the customers who are paying well get rewarded to actually get better products down the line. Mm-hmm. On their own.
So does that mean you're also funding loans off your own balance sheet, right? Is that who is selling to these banks?
Yeah. So we are not funding it anything through our balance sheet. What we have done is that for all these institutional guys, we have set up like a back-end securitization.
Okay.
So typically, if you see that, typically these institutions will go and get a securitization done with the investment banks and all that, but this has become like a, securitization channel for them, where they don't have to go to iBanks. They can directly go to banks through our platform. And these are the banks who have been traditional lenders, or they are large wholesale commercial lenders, but now they also come under the purview of Federal Reserve. So they have to book their small business loans both for CRA requirements, which is the Community Reinvestment Act, as well as if they want to book loans under their SBA norms. So they have to do that. So for banks and for these institutional investors, it becomes a win-win situation, while our platform can take care of all the data, all the scorecards, all the servicing, post-servicing, closing, and also transferring the title over from the institution guys to the banks in a very seamless manner.
Right. Well, that's nice for to get that kind of liquidity outside of the securitization market. So you can bypass the investment banks and do it directly. That's got to be a nice offering to have. So
yeah, and that is also less credit market dependent.
Yes, indeed. That's a good thing. Particularly, it seems like these days.
Exactly,
So I want to talk about some of your partnerships that you've done. You did this partnership with Univision last year. Can you give us an update on how that is going?
Yeah. So the Univision partnership has gone pretty well. We are now expanding it. We started it in Dallas area. Now we are expanding it in Miami, New York, and LA area. And what we have found out again is that, for any ethnic community, it's not just credit. It has to be a lot more than credit. They're also seeking a lot of education. They're also seeking a lot of guidance, whether it's ethnic communities or women-owned businesses. And what we are now doing is that we are actually, as the next phase in the partnership, we are actually investing a lot of money in creating that value-added content with Univision and going to these different areas where there's a large Hispanic population of small businesses, and also, doing now on-ground conferences and seminars where, both the business owners as well as their accountants, CPAs, who actually deal with them on a day-to-day basis, can get educated, and they can also start using our platform, especially CPAs and accountants, to start offering access to credit and other value-added services, especially the virtual CFO platforms, to their small business clients also.
Mm-hmm, mm-hmm. Okay, so also speaking of accountants, I mean, you also have a partnership with CPA.com. Can you tell us about that one and what that's all about?
Yeah, so the partnership with CPA.com is a very interesting partnership, and like if you go on CPA.com, there you can see we are on their homepage and we have created a whole microsite. And what we are doing is that we are following the footsteps of guys like Paychex or some of the other large providers in other parts of the, I would say, like doing payroll services and all that. And what we are going is beyond just offering like a microsite and all that. We are also starting to offer three things. We are starting to offer the services to CPAs themselves to have a cloud-based platform, a white label platform where they can offer all the business intelligence tools, access to credit, and they can know their customers better, through a white label platform of Biz2Credit. The second thing we are also doing is that, we have developed a new piece of technology, which is pretty cool, is that, now CPAs can just, sync up their accounting softwares, or, they can generate all these PDF documents from the accounting software, drag and drop it directly into their white label platform. And then we have the ability to do OCR XML and extract all that data, do the data analytics in real time, and show all the covenants, all the ratio analysis, bank statement analysis, financial data analysis directly back to CPAs and their clients. So now CPAs can also offer this platform to their clients. So that means that now we are rolling out this platform to 45,000 plus CPA firms in the country over next 12 months time. And all these firms will have access to credit for their own needs, because there's a lot of need for firm financing right now, as well as for their clients. And then the third thing that we are doing is very interesting, is that AICPA and Biz2Credit are setting up a clearinghouse in US. So if you see, in US, one of the big challenges in the SMB space has been that, especially if you're a privately held company, which 99.9% of the SMBs are, is that you don't need any audited financials. So you can have a compiled financials, and then you can file your tax returns, which are all cash-based kind of stuff. So like tax returns are not really accrual-based. And one big challenge that happens with that is that when you're looking to do financing, especially banks or lenders who are trying to, lend more than, let's say, $250,000 for, multiple year terms, that data gets very difficult to extract, and it's very expensive to keep getting that data on an ongoing basis. So in a country like US, there is something known as Companies House, which is mandated by UK government, where every privately held company every year has to file their financials, and then any lender can get access to those financials directly from the Companies House. So like they know that these are audited financials. So one thing we are setting up in US with AICPA, which is a statutory body, is a clearing house where now CPAs will be able to just sync up their accounting platforms directly there, and we will be able to extract a lot of data on their private clients. And with the consent of those private companies, then if they are looking for access to credit or ongoing loan covenants, we will be able to extract all that data, do all the analysis in real time, assign them a score, and then the lenders can use it from one single place as a data repository to get all that data, which is already pre-authenticated and pre-validated by AICPA, actually. So that we feel is going to be a big change in the market, because that will clearly mean that now you don't have to go from a CPA to CPA to get access to the data of the financials of their customers. As a lender, you can just get it from one single clearing house, and that way, it streamlines the processes, and then you can get ongoing data also.
Wow, that's really fascinating, Rohit. I mean, I think that could be a real game changer. I mean, it's one of the things that I've always thought. Like Companies House in the UK is something that everyone refers to if they're in the small business space, and there just isn't there isn't an equivalent here in this country. And I think that if you can pull that off, that's going to be really impressive, and I think a real benefit to many people.
Absolutely, not just to alternative lenders, but also to traditional banks, factors, equipment. Anybody who's going to deal on the SMB side will get benefited tremendously.
Yep. No, that sounds great. So you've also done. I mean, it seems like you've been busy recently. I just was reading. I think it was last week about a recent study you've done on women-owned businesses, and you've found a whole bunch of interesting data on that. Can you give us some of the key takeaways from that study?
Yeah, so every year Biz2Credit does an annual study on small businesses. We do it in partnership with CNBC, and then we also do a webinar on the International Women's Day. And this year the study has been very interesting, because of three reasons. So obviously, the markets are improving in terms of, small businesses have seen a growth back. And what we have seen is that, obviously, business owned by women as a percentage of overall businesses are growing, pretty quickly in the economy. But having said that, we actually have found that in this economic recovery, we are seeing men-owned businesses outpacing the women-owned businesses, both in terms of revenue as well as in terms of the profitability. So that's something very interesting that we are seeing, that as more money comes back into the market in terms of easier credit standards and everything else, we have seen that actually, the women-owned businesses, their revenue grew by 12% from last year, which was the largest jump over last 6 years after the Great Recession. But at the same point of time, we have found that, men-owned businesses on an average are 60% bigger than women-owned businesses in terms of revenue. And we have seen also that, in terms of even profitability, there is a gap of almost 40 to 45%. And that means that, today what's starting to happen again is that if you're a woman-owned businesses, the probability of you getting a loan from a lending institution or from a traditional lending institution is at least 30% lower than a men-owned business because of these reasons. Smaller size of business, lower profitability. So that, we are seeing that is happening quite a bit now. That clearly means that, while women businesses in their own cohort are doing better than any time in last 6 years, compared to non-women owned businesses, they're worse off this year than last year. And the other thing that we have also found out is that, their default rates right now are actually little higher than men-owned businesses. Again, which is a little surprising, because typically in last few years of our studies, we have found their default rates to be lower. What we are finding out now is that, because they have less access to credit, they are smaller businesses, so the competition is going up again, cost of acquisition, cost of doing business because of increased competition. And we are finding them to be under a little bit more stress than the men-owned businesses. So that's something, is a little counterintuitive findings this year, but that's something very interesting. And that clearly shows that, in this time of recovery, when the economy is coming back, women-owned businesses, my expectation was that they should be doing better than what they are doing right now. And I think there's still a lot of ground to cover, for women-owned businesses to get parity with men-owned businesses, actually.
Right. Yeah, that is interesting. Certainly, it's not a message that many of the women in the industry would like to hear, but I guess that the data is showing reality. And I guess from a lender's perspective, it's obviously it doesn't matter to you whether a woman owns a business or a man owns a business. It's the metrics of the business. What you're saying is the metrics of the business are better for men-owned businesses than women.
Yes, they are, and I think that's what a lot of people don't want to hear. But we look at numbers. We are not looking at surveys.
Yep.
We are not doing any opinion-based surveys. We are looking at hard numbers, and we are looking at the performance data because we are handling almost 7,000 to 8,000 new applications a month, and we can see who's getting approved, who's not getting approved at the end of the day. And what we are seeing is that this is something that is, overall, it's a good news, growing pretty quick, 12% year-on-year growth, which is very impressive. But we are seeing some slippages in the overall performance of these businesses,
right.
Which is not a good news.
Right. Well, so let's talk about those approval rates. I know that you study those as well. Approval rates at banks and credit unions for small business loans. What trends are you seeing there?
So we are starting to see some very interesting trends. So we are starting to see that big banks have come back, not as forcefully as people expected them, but still they are getting back. We are seeing slippages, continuous slippages in credit unions and small banks. And one thing that we are seeing is that a large number of big banks are now looking to go digital. Mm-hmm. And my take is that over the next 1 to 1.5 years, we'll see a lot of investment from banks, a lot of announcements of partnerships with fintech firms and all that is going to happen. But all this activity mostly is going to be by big banks. So the smaller banks are trying to use the technology and everything, but I don't think that they have the resources or even the understanding today to do that. Now, talking about credit unions, I think their biggest challenge has been that they have been trying to get that bill passed in the Senate and Congress, especially Senate, where the cap on the lending limit for small businesses for credit unions is only 12.5%, and they have been trying to get that up to 27.5%. And what that does is that the credit unions, which are bigger and wanted to get deeper into small business lending, have hit their cap or are fearful to hit their cap. That's why they haven't invested a lot of money in small business lending. And the smaller credit unions don't care about it because they have very little capital as it is to start with, actually. So I think credit unions have been they were one of the winners during the Great Recession, but we are seeing a continuous slippage in their performance. Having said that, we are seeing them also actually getting more aware about going digital. So we recently, there's one very progressive credit union known as Jetstream Credit Union, which took our white label solution, and they are now experimenting a lot with that in their footprint, where they're offering these, digital loans through a white label platform of ours. So that's a very interesting experimentation we are doing with some credit unions, because we strongly believe that, credit unions have a big role to play because they are very good in their local community. Yep. They really understand, people well and businesses well. And they could be very good in terms of, not doing any reckless lending also. But I think the challenge for them also has become is that, as more and more business owners have stopped going into branches and are searching everything online, like the other data I gave, now more than 1/3 of the businesses that we are seeing today are more than 10 million in revenue. So we are starting to see, more businesses graduating online pretty quickly. And that's where, they're facing that whole challenge, small banks as well as credit unions. And I foresee next year that the approval by big banks will actually go up while, approval rates by small banks and credit unions will stay stagnant, or it can even reduce. Small banks will still do well because if you see, they are very active in the SBA loan market, so they can still cover up that gap.
Right.
But not the credit union. So I think that's where the challenge is for a lot of credit unions. Right.
Right. So just I want to touch on that. You mentioned your white label solution, and that was it specifically for credit unions, or can you just talk a little bit about that?
Yeah. So, one of the things that I've been saying and I've been writing a lot about is the growing convergence that's going to happen. And I think this Chase on deck deal was first example of that, actually, which is still getting implemented. So So we are seeing a lot of demand from banks and other, institutions, coming in who want to now white label the platform, both the technology as well as data analytics. And I think one thing which nobody has talked, which I'm really surprised, is that why big banks are going to do it even more than anybody else is because of Basel III. Because what Basel III does is that by 2017, any bank who is above 50 billion in assets, needs to either have a scorecarded model for small and mid-sized loans, or they will have to allocate 100% risk capital towards those loans, actually. And that's going to, create a lot of issues because the ROE and the ROI is going to just keep going down. And as you know, big banks are under a lot of pressure to, now shore up the return on equity. And Basel III is going to make it even more tough for them if they don't have scorecard models. If they have scorecard models, then that capital allocation can go down up to as little as 20%. So like you make a loan for 100K and you can only allocate a risk capital of 20K, otherwise it could be 100%, kind of stuff. So one of the things that, we are seeing is a lot of demand from banks right now who are coming and saying that we need to license the technology. Obviously, we cannot develop it in-house, but we also need all these scorecards. And, we announced a deal with Customers Bank, which is a $10 billion bank in Philadelphia. So we're launching that platform with them sometime in April, May timeframe, where it will be in all their bank branches and everywhere else. We have done some other partnerships like with this credit union, Jetstream. We have a partnership with the U.S. Treasury and Citi Community Reinvestment arm of Citibank, known as DC Small Biz Loans. And we are in process of also, doing some very interesting announcements, partnership announcement with large banks over the next few weeks' time, where they are coming in and, licensing the whole platform to put it on their websites, in their branch networks, as well as, use our scorecards from a retro analysis perspective, as well as going forward, actually. So we think that, that's the way the future will look like, where there will be a lot of convergence between fintech players and banks. There will be more acquisitions which will happen. There will be, more cross-pollination of technology and data science. And also, banks are also looking, or they're under pressure to start doing more risk-based pricing also.
Right, actually. Right. Yep, for sure. And that's great because, one of the things about credit unions, as you say, they're very strong locally, but they don't have the intelligence or the resources to be able to create a sophisticated small business credit scoring card like you guys have got. So it's a logical marriage if they want to expand beyond their local district, and they'll be able to be able to do that intelligently. And I think that's a sort of a win-win again. So anyway. Yeah. Before I let you go, I really want to talk to you about the economy, and you have a pretty unique perspective. You've got your virtual CFO product, but you've also, you've got all these studies that you do and different partnerships and your own, people who are coming to you for loans. I'm curious to see how you see the economy like today and what trends you're seeing, if we might be starting to see things get worse or if things are actually looking okay. Where are you at with that?
Yeah, so I think that's a very interesting question, and the key thing here is that the Main Street economy, which is the small business economy, is actually doing pretty well right now. It really doesn't get much impacted by stock market, until unless there's a big squeeze on credit, kind of stuff, or that increases the joblessness rate, actually. So till that doesn't happen, the Main Street economy will do well. Actually, over last 1 year, it has got tremendous benefit of low gas prices, actually. Not just because of the fact that the consumer spending has gone up. Consumer spending has gone up in only in few areas like hospitality, travel, dining outside like restaurants. So like those segments in our small business portfolios are doing very well right now. They're like up 10 to 15% year on year right now. Such a tremendous growth we have seen, actually. It's also a question of, for most of small businesses, their operating costs have gone down. So like we have a lot of transportation and logistics business in our platform. We have a lot of gas stations that we finance. And we have seen that the drop of the oil prices also helped them tremendously to, lower their operating cost as well as, get more money to be spent in areas that is more profitable. So an example is that a gas station, when a consumer is coming in and they have to spend less money on filling the gas tank up, they are buying more stuff from the C-store where the margins are a lot higher compared to the fuel pump, actually. So we are seeing that, that the revenues have gone down, of most of the gas station, guys, their revenue has dropped like 40-50% because the gas prices have dropped so much. But their profitability actually has gone up. So their need for working capital overall has gone down because now they don't need so much of money to buy fuel all day long because, the fuel costs them less, while the profitability has gone up. So which is a good news for them, in that sense. Where we are seeing some negative signs are that, is that the sentiment still is a little fragile, especially what happens is that at the end of the day, most of the small businesses just, depend on the sentiment and the motivation of the small business owners, unlike large companies. So and they are also consumers. So at the end of the day, if they see too much of negative news, they don't feel very confident about investing a lot of money or reinvesting a lot of money back into business. And that's where, things slow down when any of these negative news keep coming in. Having said that, what I have seen a lot of historical economic data, whether it was 1987, 97, 2007, I think it happens almost every 10 years, 9 to 10 years, is that whenever the global economy or some of the other large countries get into a funk, it actually helps America. So the next 3, 4, 5 months are very volatile. So all this volatility started sometime in August, September. But if you see the historical 1987 and all that was that, 6 months were very rough and tough, including Black Monday. But after that, the next 2 years were the best for the economy, actually, before the recession came in. So my take on that is that if things move the way they are moving, then, the economy will do pretty well. The only thing is some lenders will go over exuberant and then, they will lower their underwriting standards and, that can create issues. And I think that should not be a big challenge right now because markets are pretty credit starved. And I think there will be some increase in the interest rates, but, I don't foresee much of that because, the inflation is so low right now, actually.
Right. A good point. Okay, that's good to hear. So last question, what are some of the interesting things that are coming down the pipe at Biz2Credit? What are you working on?
So there are two or three things. One, obviously, we are working with a large number of banks, both in US as well as internationally, and we are about to announce some large transformational deals, where our technology, our data science will start getting used by these very large global banks to, run their whole SMB businesses, portfolios and also the loan origination underwriting kind of businesses using our scorecards. So I think that's happening. I think the other thing we are seeing is a lot of convergence coming in. So, we did a partnership with Heartland Payments, which was recently acquired by Global, and now a lot of other payment guys are talking to us to actually have a similar partnership where we can extract all the historical data, credit card transactional data, and then data going forward, and can put it back into our scorecards. And I think the third thing, which is the most exciting, is that we are seeing a huge migration of businesses now in the online space. I think our last 1.5 years, this has just accelerated. And my prediction is that in next 18 to 24 months, we'll see that most of the good businesses, viable businesses will first go online, and then they will look at any other options. So that clearly means that banks will have to restructure their branch networks pretty quickly. They will have to go digital very quickly, and they will have to provide a mobile first kind of an experience very quickly, because that's the other thing where the mobile traffic is just exploding right now.
Right. Well, that's good news for people like you, and not so good news if you work at a traditional bank. But anyway, I have to let you go, Rohit. I always find it fascinating chatting with you. Thank you very much for your time.
Yeah, and Peter, thanks a lot for the opportunity.
Okay.
See
ya. We've talked a lot about the growth of this industry and about the disruption that's happening. But I think Rohit hit it on the head in one of the last things he said there was when he says the small business owner today is going online first in more and more circumstances. So they're looking for a loan online. They're not going to their branch. They're not going to their local bank or where they have their checking account. Because let's face it, all these small business owners have a banking relationship already, but they're often now choosing to go online first. That is, and will continue to be, I think, a major tailwind for this industry. And it's something that if I was working at a traditional bank, I would be most worried about. Traditional banks right now still have not got their online processes down. Companies like Biz2Credit and some of their competitors make it extremely easy now for small business owners to obtain a loan, and word is getting around. So I think, these companies like Biz2Credit are going to continue to thrive because they've made it easier for their target customer to obtain their product. And I think it's it's something that is not going to change back to the way it was before. We are going to have more and more people go online for loans than ever before, and it's a trend that is just going to continue going for many, many years to come. Anyway, on that note, I will sign off. I very much appreciate you listening, and I will catch you next time. Bye.